In chapter 14, we're going to be talking about what happens when someone who owes you money, which that account is called accounts receivable, what happens if we don't receive that money, which is very possible. So first, it's important to understand what we talk about when we say we are not receiving that money. That means that they owe us money and they are not going to pay us. That is called an uncollectible account, or maybe called bad debt. So we use this in a situation where a company owes us money and we've maybe tried using a collection agency and they are not going to pay us back. So the first thing we need to do is we need to estimate how much that is going to be. So we will use the allowance method for recording losses for uncollectible accounts. So we're going to have a couple new accounts this chapter. And the reason that we're going to have these accounts is to determine what the book value of accounts receivable is. So accounts receivable would be the amount that companies owe us. And if you want to look at the accounts receivable balance, you would need to look at accounts receivable, subtract the allowance for uncollectible accounts, which is the new account that we have. So allowance for uncollectible accounts decreases accounts receivable, just like, for instance, purchases discount decreases purchases. So the amount that we decide that we're actually going to receive, that's called the net realizable value. And remember that accounts receivable are assets. So those have value to our business because eventually it's going to become cash, right? When they eventually pay us. Well, if we've determined that we are not going to ever receive that money, maybe the company filed for bankruptcy, then that's no longer an asset. That would be an expense for our company. So we need to adjust our accounting to be as accurate as possible and change that asset to an expense. So there's a couple ways we could estimate how much money is actually not going to be collected. Two examples here. You just take a straight percentage of the total sales and say, you know what, let's estimate that money we're never going to collect. Or a percentage of accounts receivable. So however much you sell on account, you'll say a percentage of that we are most likely never going to collect. The method that we are going to use is called the aging of accounts receivable. So the aging of accounts receivable, we'll look at a chart similar to this. So we could see here that we have all of these customers that owe us money. And you could see here the variation of how often they are late. So for this one, Belk and Jensen, it looks like they have some that is past due and some that is not quite due yet. So current would mean that it's not late yet. And past due, you could see the variation of either 1 to 30 days, 31 to 60 days, etc. So you could see here on this bottom chart that if it's current, so that means it's not late yet. So even though it's not late, we still estimate that 1% of that we will never collect. So we take the total amount that's current times 1%, and we can estimate $117 we won't collect of that. And so on for the variations of how many days you could be late. So you'll notice the more late they are, over 90 days, we estimate that over 90 days, if they haven't paid us, they're almost 3 months late, we probably won't collect 80% of that. And these percentages would not just be a random percentages. It'd probably be using historical data and maybe using a mathematician or statistician to determine what percentages we don't typically collect. So in total, we'll estimate that $2,500 we will not collect. So we need to put that into our account called allowance for uncollectible accounts. We already have $125 in there, so we'll subtract that. And that is what we will use. So next we need to make an adjusting entry for allowance for uncollectible accounts. So you can see here, we'll put uncollectible accounts expense because it's no longer an asset. We're going to debit expense and then credit allowance for uncollectible accounts. And you can see that we're crediting it. Accounts receivable has a debit balance. So to decrease a debit balance, we'll credit allowance for uncollectible accounts, which is the contra account. So we will have adjusting entries. So there's no document number because it isn't coming from somewhere. This is an adjusting entry. That is the document number. That is telling someone where you'd find these numbers. Last date of the year, we'll do this adjusting entry, debit our expense, credit allowance for uncollectible accounts. And that is section 14-1, when we make an estimate of how much we think we will not collect from our accounts receivable and move it from an asset to an expense to update our accounting.